Welcome to the Cash Flow Project Podcast. Are you looking to better your financial situation by increasing your cash flow? Too busy to hunt for real estate deals or don't know where to start? Then you're in the right spot. Join us as we dive in and talk about investing for cash flow using multifamily real estate.
Welcome to the Cash Flow Project. I'm your host, Vince Gethings with Tri-City Equity Group. Today, we have Brian Eastman on the show, and I am joined by my co-host, Steve Fierros. Steve?
Yeah, you're definitely going to want to take a listen to today's podcast. You're going to be super excited interviewing Brian Eastman. He's dropped some excellent knowledge in terms of what to do with your retirement accounts. If you got something that's underperforming, Brian did an awesome job of letting us know different options for those retirement accounts that maybe you're not satisfied with, especially with the current market volatility. So definitely stay tuned.
Brian Eastman is a principal and senior consultant at Safeguard Advisors based in Boulder, Colorado. Mr. Eastman has personally worked with thousands of independent investors over the years and has a deep understanding not only for the tax framework that governs self-directed retirement plans, but how to actually use such a plan successfully in a variety of real estate related transaction types. Mr. Eastman has been investing in real estate personally with his self-directed plan for 15 years and has participated in subdivision development, flipping properties, rentals, lease options, and deed trust financing of various types of property. Welcome to the show, Brian.
Hey, thanks for having me. Glad to be here today.
Outstanding. All right, well, let's jump right into it. You did a lot of work for us with your sheet you sent over with suggested topics and questions. So I'm going to dive right into that. So for our listeners, can you just explain and dispel some of the myths about self-directed IRAs and the solo 401k plans?
Sure. Yeah. So what our business does, what we've done for 15 years, is we specialize in what are called self-directed retirement plans with a specialty in what we call checkbook control. And really, at the end of the day, it's a tax-sheltered bucket of money, just like your corporate 401k plan, just like an IRA at Fidelity or Vanguard. All the tax rules, all the timelines, all the reporting and beneficiary, nothing changes on that back end. Hey, this is this tax-sheltered retirement plan. What changes is your investment choices. With a self-directed plan, you're not limited to what the platform sells, which, you go to Vanguard or Fidelity and it's the stock market, but rather you can invest in anything that the IRS rules allow for. And going back to the 1970s, when IRAs and 401ks were first created, there's almost limitless options. There's actually only a handful of things that you can't invest in, which are namely collectibles like artwork and jewelry and, antiques, things like that, and life insurance policies. Everything else is feasible, although not everything necessarily makes sense inside of the IRA umbrella. There's an angle there too. But that opens up the possibility beyond publicly traded stocks to things like real estate partnerships, private lending, like the trust deeds I mentioned that I do with my IRA, just a whole host of different things, precious metals, cryptocurrencies. But I would say that 80 to 85% of our business is clients wanting to invest in real estate in some fashion because of the different asset profile, the true diversification that you get. And at the end of the day, that's what it's about. It's about diversification of that retirement money. It's not, hey, how do I get my hands on this money differently or anything like that. It's just a different way to invest those retirement funds. Great.
So who is the perfect person? Like, what is the avatar of the perfect person that this is a investment that, or somebody that would benefit the most for this type of alternative plan?
Sure. Well, that's a pretty broad picture, and there's a real wide variety of people that we serve. But generally speaking, it's somebody who's been in their career for a little while. If you're going to invest in real estate, you're not going to do it with 10 grand and, you're fresh out of college and got your first 401k contribution, right? Typically, it's somebody who's been in a career for a while, had, a 401k or a SEP IRA or something. They've accumulated some money and they've changed jobs at least once, because typically your current 401k isn't going to be accessible. to be moved to another plan format. It's going to be stuck in that plan. So for the most part, we're dealing with folks, I mean, I've got clients in their late 20s, but for the most part, people are 45 to 65. They've accumulated a good amount of wealth in their savings, and they're looking at it and they're saying 100% of this is in the stock market. Yeah, it's diversified in this type of asset and this type of, but ultimately it's all publicly traded, market-sensitive assets. I want to get some of it into some real assets. And so it's that person who's, has enough horsepower that diversification is starting to become important to them. And again, that's a different point for a lot of different people, but that's the underlying principle. Got
it. All right. You mentioned some tax issues, like some are the same, or a lot of them are the same as other retirement vehicles, but then some are different when doing the solo or the self-directed. Can you explain some of the different tax either advantages or disadvantages?
Yeah, I mean, as an IRA, all the taxation rules are the same. Self-direction doesn't change that. Now, there's two types of self-directed retirement plans. There's IRAs, which are sort of a nice tool for taking some existing savings and getting some control over it. They're more of an investment-focused vehicle. And then there's 401ks. We happen to offer an individual 401k for people who have their own business. So they're self-employed. They don't have any full-time employees. They might be a realtor or an independent tech consultant or something like that. And in addition to that investment flexibility, they get the high contribution limits that come with a 401k style retirement plan. So not only can they invest differently, but they can feed their plan on the front end and take the tax savings of potentially putting as much as $57,000 a year as of this year into the plan and reducing their taxes as a result. So that's true whether it's our style of plan or a plan you go get at Schwab or Vanguard or someplace like that. When you start investing with a self-directed retirement plan, the nature of what you're doing can create some tax implications inside of an IRA. And we've jumped right to a real meaty part of this whole topic and conversation, but that's fine. We'll go a little out of order. That's fine. And basically there's two things, three things to look at. These tax-sheltered vehicles are meant for investing at arm's length in passive income-producing things. And passive income is dividends, like what we're all used to in the publicly traded stock market, interest, royalties, rent from real property, say as in an apartment syndication, or the eventual sale of one of those assets that's been held passively over time. They're not designed for conducting a business. When you invest in a business like a Ford or a Boeing, you're investing in a stock, and it can go up in value or it can produce dividends. But basically, the corporation is operating its business, it's paying taxes, and then it's issuing tax-preferred dividends, passive dividends to its investors. So as an IRA, you receive those dividends, they're fully tax-sheltered. If you were to go invest in a small business, say a restaurant or a car wash or something like that with your IRA, and it wasn't a corporation paying taxes and then issuing dividends, but rather it was a pass-through like a partnership or an LLC, well, there's never been any taxes paid on that business income, and the IRA is going to receive that, and it's going to have some tax owed on that. So certain types of venture capital can create some tax implications inside of an IRA. It may or may not be a deal killer, depending on the type of investment. I mean, if it's a venture capital deal and there's going to be a little bit of operating income that might be taxed, but the real prize is I'm buying in on the ground floor, and if this goes public, we're going to sell this for a bunch of money later, that rise in equity wouldn't be taxed. It would just be operating income. So the fact that there's taxation may not be an issue in that type of thing, but it's something to pay attention to, and we're working with a firm like ourselves who can evaluate what you're doing, guide you, and consult with you to tell you whether things make sense or not is important. The one that really impacts investors in the sphere where you're operating, and mostly in our real estate sphere, is there can also be a tax on leveraged investments. So say, for instance, you're buying into a real estate multifamily syndication. Usually a syndicator is going to bring in 30% investor money. They're going to go borrow 70% from a bank. Well, that deal's now leveraged. It's got debt financing. And the return that those IRA investors are receiving isn't just based on their IRA capital, but it's also derived from the borrowed money. So the portion of the income that the IRA receives that comes from that borrowed capital is subject to some taxation. Now, I don't want to go into the weeds and explain all that, and anybody's interested in it, we can talk about it, but it's a small amount of friction. And it's basically just a little bit of friction against that leveraged boost in return. But you're still very much going to see a leveraged higher cash-on-cash return. You're going to pay a little bit of tax out of the IRA for the right to do that. just to summarize, just to put people at rest about this, in a typical, like say 5 to 7 year added value multifamily syndication, you might lose 1% of your gross return to taxation, and I'm including not only the tax but also the filing work. So a deal is going to produce 15% return, you might get 14. It's not going to hurt things, but that's going to be way better than the 8 or 9% you might get on an all cash deal that wouldn't have that tax exposure.
Exactly. That's a great point. So yeah, the UDFI is the tax that when people start Googling and researching things like this, they see the UFI tax and they start freaking out. And I've personally had conversations with investors that they started like pumping the brakes and like, wait a second, I don't want to get taxed on this extra stuff. And then you try to show them the math and put them at ease, like you said, or put it to rest. Like, look, this is still a better benefit than if you were to do nothing. So it's very important just to be aware of it. Like, this is something that can happen depending on how we structure the deal. The overall, the returns will usually make it insignificant by the end of the exit of that deal.
Yeah, absolutely. And I just always get to that bottom line, whether there's a cost. I like to say take the word tax out of the equation because that pollutes people's thinking. There's a cost to participating in this investment. Net of all costs, what's your net final return? Is it a good number? Is it a secure investment? If the answer is yes, great. Because in these real estate syndications, it's not like you're doing a lot of complex tax return. You're not doing this IRA tax filing on TurboTax. It's not even available. You're going to hire your CPA and you're going to give them a K1. You're going to hand them a K1. It's a small return. It's not going to cost you a ton, and it's a small amount of tax, and you're getting a better investment. It's just really, really simple.
Absolutely. And then with, at least for the next couple of years, we have, bonus depreciation. So we do a cost segregation on a property, which accelerates the depreciation of that asset. Bonus depreciation under the current laws that, that passive loss that we're going to be giving to investors over the first, second, or third year as we start handing out those K1s with that passive loss is pretty much going to wipe it out anyway.
Well, actually, no. That's fantastic for your after-tax investors. In the IRA, they got to take straight line depreciation. They don't get to use the accelerated cost seg and the bonus depreciation.
Cool.
Yeah.
I thought it was.
So you learn something new, but yeah, it's still, the impact is so nominal. And actually, a lot of times on these syndications, if you're doing a value add and you got investment cost and rehabilitating properties and whatnot, oftentimes there's a zero tax in the first couple of years. It's usually such a small loss that it's not worth filing a return to carry that loss forward. You in theory could, but are you going to spend $200 on a return to carry forward $80 in taxes? Probably not. But it's oftentimes the third or fourth year before you start seeing any tax impact. And again, over the life cycle of most investments, it's a small impact.
Got it. All right, Steve, you're up. What kind of questions you got?
Yeah. So, Brian, what kind of now? Obviously, we're at the recording of this our call with you right now. We've got some pretty incredible market volatility. We've got some some different dynamics happening in the in the market as a whole. What kind of impact are you seeing or response from your clients, or questions are you getting in response to the whole COVID thing and how it's affecting their accounts and maybe their investment strategy?
Sure. It's similar but different from 28 through 2010. Initially we saw a real shock to the markets. People like to say my 401k became a 201k. I don't think it was quite that extreme this time. But yeah, people saw a lot of loss, and as I was explaining in the intro before we spoke, a lot of people just froze, and that's a natural reaction. It's probably the smart reaction. I mean, you shouldn't panic and sell. Why bake in a loss, right? So, but everybody sort of took a pause on their investments. I'll be honest, our business volume slid for a couple of weeks as people sort of took that pause, and we were expecting it because we've been around long enough and been through some cycles. We're starting to see a real uptick. The market's rebounded a little bit, and a lot of people who maybe just really didn't pay that much attention to their retirement portfolio, which is so classic. You show up at your corporate job, you throw money in your 401k, your employer gives you a match, but you only got, 4 or 5 mutual funds you can pick to invest in. You're not giving it a lot of thought. It's in a way designed that way on purpose for a lot of both psychological and financial benefit reasons to Wall Street. But most people don't think about their retirement portfolio. It's just piggy bank, set it aside, forget about it. Well, when these types of events happen, people start thinking about it, and they should, because everybody in financial services talks about diversification. Well, even if you're in a variety of different stock-based investments, you're not diversified. You want to have a mix of asset classes, and real estate and other real estate-backed ventures, partnership interests, which isn't technically, you don't really own the real estate, you own a partnership that owns the real estate, but it's still real estate-backed. And real estate works very differently, and that's actually where we're seeing a big difference between now and 10 years ago, because back then it was real estate and bad real estate finance structures that were really the root of the problem. Here it's not the case, and we still have a tremendous supply deficit in real estate. And so I don't expect that we'll see a big bump, and where I do actually see that we'll see a big bump is there are going to be people who are financially tenuous enough that they're going to get bumped out of their houses. It's going to be unfortunate, or it's going to be painful, but there's going to be a lot of people who are today homeowners who are going to become renters. And we're going to see a continuing shift towards a more renter-based population. So for people who are offering quality rental properties, there's going to be demand. So those properties are going to be solid. It may produce some buying opportunities. Again, not so much the underlying value of properties right now, but if you've got somebody who's not running a project well, or they're not well financed, they could get themselves in some difficulties where it could create opportunistic buying potential. So I see some real potential in the real estate space, and I expect, as we've seen in the past, a real big flood of money in that direction.
Oh yeah, I'm sure, and we'd love to be able to send some people, if we get questions, of course, and we have I know we have before to seek out your advisement. I love that in your actual company name, the Safeguard Advisors, and that's a part of your service as well. Is the advisement of hey, I've got this 401k, or I've got this retirement account just kind of sitting around. What should I do with it? Or what can I do with it? Mm-hmm. So, because I understand.
Yeah, we won't tell people where to invest their money. That requires securities licensing and a whole bunch of stuff. But yeah, we'll tell them what their options are and help them vet those options, make sure they're doing stuff that makes sense within the IRA umbrella. Absolutely.
Right. That kind of brings me to a point earlier that you made. Kind of an ideal client for you, or people that you would typically work with. Working professionals, and maybe have switched jobs at least once, so they've got access to a prior account that's maybe underperforming. Is there a typical minimum dollar amount that you would see where it kind of makes sense? Like, hey, I've got $50,000 in my account. Is that something I can put to work?
It's going to depend a little bit on what they want to invest in. I mean, we don't have a hard minimum. We typically don't feel we're really adding value for people at much below that $50,000 threshold, although I do have some investors, especially somebody younger who's going to use this vehicle for 20 years. Yeah, I'm starting out a little below where I'm getting a benefit today, but over the long haul, I'm going to see benefit, and especially if they're in our 401k where they're going to be adding with contributions in addition to their investment. So again, a real wide mix, but I would say for the sort of the sweet spot is somebody with between about 75 and 150, and frankly, that's most people. I mean, you see the numbers that the big players like Fidelity put out. That's the average 401k balance in America across people of all ages. So obviously that means there's people who've got $1 million, or people who've got $50,000, and a bunch in between. But most people are in that 75, 150 range. And if you're taking some of that and you're moving it into some investments that produce more asset security, consistent, predictable returns. You're not hitting home runs. You're hitting a single or a double every time you come up to the plate. Well, guess what? You put a lot of runs on the board. So if you see value through the different investments that you're capable of making, then you'll see value in the tool we provide. But it is maybe that $80,000, $100,000 threshold is sort of not a hard and fast, but a sort of a good baseline.
Gotcha. And earlier you mentioned, obviously you've got greater opportunities that you can invest your money in, going with, having that kind of checkbook control that I know that you talk about. Is there, we mentioned briefly about arm's length kind of investments. Can you dive a little bit deeper into that and can you maybe talk about some different opportunities or things that could be a good fit and maybe some that aren't?
Sure. Again, things have to be arm's length. With this IRA tax-sheltered money, the IRS rules stipulate that everything must be done within the envelope of the IRA and exclusively for the benefit of the IRA. So you can't mix IRA funds and personal funds. You can't use your IRA to pay off your personal mortgage or buy a second home that you want to vacation in, or a home for your kid to live in while they're in college, or in other ways personally interact. And that's a prohibition that extends not only the IRA account holder, but a larger group called disqualified persons. I'll simplify it to say lineal family is 90% of it. There's a few others, but parents, grandparents, children, grandchildren, your spouse, businesses that you or your family control. So you can't interact IRA money and personal money. So when you look at things to invest in, it's something where, hey, you're in full control. You're deciding. You're a fund manager. You're deciding what the money is going to go into. You can execute transactions, sign a contract, spend the money to pay for acquisition and expenses, receive into the plan the money that's being generated by those investments. You can go put that money to work, but that's about the extent of what you can do. Again, we talked about passive income as opposed to trade or business income being desirable too. So that leads us to another sort of category of things. So we see clients buying a single family rental or a duplex or fourplex. We see clients joining in small partnerships, 3 or 4 investors to go buy an 8-unit or a 10-unit or something like that. And some of those people could have IRA money, some could be non-IRA money. It can't, maybe include your dad. It might just be network of business associates and friends and whatnot. Now, there's some other family member like cousins and siblings and what your IRA can deal with. We see people joining into larger partnerships, real estate syndications. That has been a huge part of our business since 2015 when the rules about fundraising relaxed and opened that up to a much broader audience of people. So we see a ton of that. We really like, and we see a lot of clients investing in private lending. So maybe, financing other people's real estate deals like flips. Things like that. Flipping with an IRA is a business, so direct flipping with the IRA typically doesn't make sense, but hard money lending to a flipper or buying a house, fixing it up, and then holding it as rental for a while to make it a passive transaction and then selling at least a year down the road, what we call a hybrid flip. And then we see, venture capital and precious metals and cryptocurrencies. And of course, within these vehicles, you can still do the stock market. You wouldn't do it set up this vehicle just for that purpose. But if you're getting, distributions off of an investment and you want a house somewhere to put, an extra $5,000 that you're not going to buy another piece of real estate with, you can put that in the market. So those are the types of things that we commonly see. And like I said, about probably 85% of our business is some way in shape or form associated with real estate. It's just what people are comfortable with and can get their minds around and that makes sense in these vehicles.
Awesome.
Nice.
Awesome. Yeah. Well, I'm actually kind of curious. I know that you've got some experience with your own investments. Can you tell us a little bit just kind of about, you mentioned, flips and, kind of in your bio, you've got a little bit of a background in that. I'm just curious as to, is that something that you're still doing or, is that, no, this keeps me busy enough and, helping other folks, become more astute in their financial investments, or is that something that you're still involved in?
No, it's evolved. So I spent the first part of my career in software technology, and around 2005, a small company I was working for that was fantastic got acquired twice in the same year, and then it was no fun. And so I stepped away, and I actually personally made a living for about 3 years until the crash flipping houses. So my experience flipping is non-IRA money. That was my business. That's what I was doing. But I developed a lot of experience about real estate and actually did really well at that particular period in time, doing that for a couple of years. But then I could fix the houses up as nice as I wanted, and nobody could get a loan to buy them after 2008. So kind of put a little hole in that. I did some subdivisions. So some of those things I recommend or mentioned in my bio have to do with non-IRA. But it's the real estate expertise. So when we have clients coming to us and they have an interest in doing stuff, well, we speak the language. We know real estate transactions of a lot of different flavors and how it intersects with the IRA, so it brings value. With my IRA, I have held a rental property. For the most part, I like doing private lending. And the reason is the time that I was out flipping, I built a good network, and I know a bunch of guys who still flip, 100 houses a year today, and I know them, and I trust them, and I know the markets that they operate in, and I can basically underwrite the deals, and it's a simple little network of trust. So I just park my money with those guys and, get about 12, 13% depending on the deal, and it's pretty simple. I've done a few other things as well. I have participated in one syndication, but for the most part with the IRA, just the time of my time value is just says, hey, something simple, something is easy for me to understand. I do the lending, but you can do a lot of other things with it.
That's awesome.
Nice.
Yeah, I'm sure that's a huge credibility piece for you, like that. Just like you said, your clients, hey, if you're interested in doing real estate, it's like, hey, I've got a background in it, right? I know your pain.
You speak the language, it always helps. And you know the little pitfalls. You know, when you come in with an IRA, there's things you can't necessarily do that you could do in a personally financed transaction, like just whip out your credit card and take care of a problem, right? It's all got to come from the IRA. So it requires a little different thinking about your entrance to deals, sometimes because of the passive nature of things, a little different thinking about what your exit strategies may be. In a personal deal, you might have 5 potential exit strategies. In an IRA, only 3 or 4 of those might make sense. So being able to, sort of chart that out on the front end is real beneficial for investors.
Awesome.
Back to me?
Yeah.
All right.
So.
Nice. So we're going to go into the fire round, so to speak, on this. So 5 easy questions for you. We'll softball them to you. So what is your favorite book that you recommend other than Rich Dad Poor Dad?
That's a good one. I like it. There's a couple, but I mean the one, anytime anybody asks, it's the Make Friends and Influence People, the Carnegie stuff, because networking and the power of connections is such a driver for anything you're doing, and it's so timeless and classic. So that's a top of the list. And then, I mean, there's a handful of books I've read on specific real estate transaction types, but they're so specific that, I don't know that they add a lot of value to a list like that.
Yep, and the book is How to Win Friends and Influence People by Dale Carnegie. I think it should be a required reading for every high school senior before they get into the real world. Absolutely. I've given that book out more than any other book ever.
Yep.
So.
Yep.
Absolutely. So what is your superpower?
It's speaking English in these very complex matters. It's taken all the gobbledygook of retirement plans, which people just don't touch it very often. You might touch your retirement plan, move stuff around once or twice or 3 times in your lifetime. So it's just a foreign language to people. Same with the tax code. So taking all these different complex subjects and twining them into a digestible, understandable framework for people, that's what makes our business tick and why we've had the success we've had.
Exactly, and it's a huge point because, I just read what's his name, Oren Klaff's book, The Pitch Anything, and he goes in a huge bit on just the brain, how it works, and it's essentially when people get overwhelmed and they just don't understand something, they just freeze and they don't go after it. And with the way that the tax codes work and these super complex retirement structures, a lot of people are just like, that's too much. I'm just not going to mess with it. What's the easy button? That I don't want to, get into something that I'm not going to be able to handle. So having the ability to break that down to very, like you said, digestible chunks and speak plain English on it is huge value added. Absolutely.
Yeah. And I would say there's approaches that people come to us with retirement plans that are not the easy button. And sometimes we'll help people say, oh, here is an easy button approach that achieves many of the same goals you have about getting better results for your retirement plan and shift their thoughts. Or, we can handle the complex if somebody else can get their mind around it. But there is, in my sort of personal preference, do what's easy, do what's simple. It makes a lot of sense. Absolutely.
So what are your hobbies?
Well, I'm watching my son's hockey team. He's pretty elite. He'll probably get some college money for playing hockey, and we support the team and its interests. And I love the backcountry. Part of why I love living here in Colorado is just a lot of great mountain spaces to get out and get away from the hustle bustle of the regular day and recharge the soul out there with big granite peaks and snowfields and whatnot.
Yeah, absolutely. I just watched the new Call of the Wild.
Oh yeah,
the one that just came out, and we're like, man, we want to go back up to like Alaska or something. Like, let's go on a hike. Like, just that draw to nature, because we've been cooped up in our houses for the last 2 months.
Now I don't know which island are you guys on?
Oahu.
We're on Oahu, yeah.
Okay, got it. So
the one with all
there's some good places to go. I like Kauai. There's some good, you can get away from it all and go out on some pretty long hikes out there. That's pretty nice stuff too.
Yep. Kalalau, have you been on that one? On Kauai?
Maybe. I don't know. It's been a long time.
It's like the 10-mile, each way hike. That's like the, beautiful sights.
No, probably didn't do that one. Gotta have more time.
All right. So I know, and I'm going to plug this, is this white paper. When I reached out to you the first time on, hey, Brian, help me out, help me understand this. And you sat down, you broke down these self-directed IRAs and for me, and you emailed me this white paper, and I thought it was so well written that we actually had it printed and bound, and we bring this with us to all of our meetups now to educate everybody that's even remotely interested. So I was going to plug that and see maybe if you wanted to, if people give their emails or whatever, however they can get a hold of you, that might be a resource for our listeners.
Sure. So we, I think I sent you an email, but I might have forgotten. So we have a special landing page for people coming through this, come through you guys. You get exposure to a $200 discount through the marketing referral on our services, and it'll be IRA123.com/Tri-City. And they can just visit that, a little introduction to us, the way they can schedule a time for an introductory consultation, and go ahead and put that in your show notes as well.
Perfect. Will do. Absolutely. And that is it for us. All right, Brian, thanks for taking the time out of your busy day to come on the show with us and drop some serious knowledge about the benefits of the self-directed IRA and solo 401k plans and how they can be used to turbocharge an individual's investments for their retirement plans.
Hey, thanks a lot for having me. It was always great to chat, and look forward to speaking again soon.
Awesome, Vince. So that was such an awesome show. Super huge thanks to Brian Eastman again with Safeguard Advisors coming on the show today and giving us some wisdom in terms of what to do with those retirement accounts that may be sitting around and underperforming. So, some of the golden nuggets that he that I was able to take away from the show, and hopefully you were as a listener too, really putting into an account, having checkbook control gives you greater options to invest in than just a volatile stock market. Clients that could hugely benefit from this particular type of strategy would be, maybe a professional, somebody that has a retirement account around, not an active one, but a prior, 401k or some other type of retirement account that you're not actively contributing to. That's actually a key. Something that your investments would be or ideal investments would be things that are going to be arm's length. So nothing that's going to be an active business, an active income provider. So, for your flips, that may not be an ideal, may not be a strategy that works for you, but it could be something that's excellent for passive income, like multifamily syndications, which we happen to specialize in. So that's a huge one. And then also to, making sure that you're aware, it may not be the best fit for everyone, but it is going to be a great fit for some people. So, $75,000 to maybe $100,000, really a $50,000 kind of a minimum would really be where you start to try and get the true benefit from, a strategy like this. To move some of that retirement money that you have sitting around. So, hopefully able to get some great gems from the show. And, what's some ways that our listeners can connect with us, Vince?
Yep. If you're interested in connecting with us, go to tricityequity.com to learn more. To connect with like-minded investors, join our Facebook group, the Honolulu Multifamily and More Facebook group. And if you found value in this podcast, please share it and give us a good rating and review on iTunes. See you next time.